Ever wondered what unit trusts are and how to invest in them? Well, buckle up because we're about to embark on a journey of discovery and understanding. Unit trusts, also known as mutual funds in some countries, are a type of investment vehicle that pools together money from many different investors. This collective pot of money is then managed by professional fund managers who invested in a diverse range of assets such as stocks, bonds, real estate, or commodities. The aim is to generate a return on the invested capital, which is then distributed among the investors. The beauty of unit trusts is that they offer a way for people who may not have a large amount of money or expertise to invest in a broad portfolio of assets. This is because your money is pooled with that of other investors, enabling you to own a piece of a large and diversified portfolio. Now you might be wondering, how does one invest in a unit trust? Well, to start, you purchase units in the trust. Each unit represents a share of the total pool of investments, and its value fluctuates based on the performance of the underlying assets. You make money when the value of the units you own increases, or when the trust pays out income, such as dividends or interest. Unit trusts come in many shapes and sizes, each with its own unique set of characteristics. Some, known as equity funds, invest primarily in stocks, while others, called bond funds, focus on fixed income securities. There are also balanced funds, which invest in a mix of stocks and bonds, and money market funds, which invest in short-term debt securities. Each type of fund has its own risk and reward profile, and it's important to understand these before making an investment decision. For instance, while equity funds may offer higher potential returns, they also carry a higher level of risk compared to bond funds. In the next few minutes, we'll dive into each type of unit trust fund, highlighting their advantages and disadvantages. So, stay tuned for an enlightening journey into the world of unit trusts. To understand how to invest wisely in unit trusts, it's crucial to familiarize yourself with the different types of unit trust funds. Let's start with money market funds. These are the safest type of unit trust funds, investing primarily in short-term, high-quality debt securities. They provide moderate returns and are best suited for conservative investors who prioritize capital preservation over high returns. Next, we have fixed income funds. These funds primarily invest in bonds and other fixed income securities, offering regular income and moderate risk. They're a good fit for investors seeking steady income and a higher return than money market funds, but with less risk than equity funds. Speaking of equity funds, these funds invest in shares of companies, and their performance is closely tied to the stock market. They offer the potential for high returns, but they also carry a higher level of risk compared to money market and fixed income funds. If you're an aggressive investor with a high risk tolerance, equity funds might be your cup of tea. Balanced funds, also known as hybrid funds, invest in a mix of equities, bonds, and money market instruments. They aim to strike a balance between risk and return, making them suitable for investors looking for moderate growth and income. Lastly, we have index funds. These funds aim to replicate the performance of a specific index, like the S&P 500. They offer broad market exposure and are typically passively managed, which can lead to lower management fees. They're a great choice for investors who believe in the efficiency of the market and want to keep their costs low. Each of these fund types has its own set of advantages and disadvantages, and the right one for you depends on your investment goals, risk tolerance, and time horizon. Don't worry if you're feeling a bit overwhelmed. We'll dive deeper into the pros and cons of each type in the next scene. Now that we've covered the types of unit trust funds, let's delve into the advantages and disadvantages of each. Each type of unit trust fund presents its own set of advantages and disadvantages. Let's delve into these, shall we? Firstly, we have equity funds, a high-risk, high-reward option. The main advantage here is the potential for substantial capital appreciation, especially over the long term. That's because these funds invest primarily in stocks, which historically have outperformed other asset classes. However, the flip side is the risk of significant losses due to market volatility. Next up are fixed income funds. These funds are typically lower risk, investing in government or corporate bonds. This makes them a great choice for conservative investors seeking steady income. However, their returns are generally lower than those of equity funds, and inflation could erode your gains over time. Balanced funds, as the name implies, offer a balance between risk and reward. They invest in both stocks and bonds, providing a mix of growth and income. The advantage here is diversification, reducing the risk of significant losses. However, the potential downside is that the returns might not be as high as a pure equity fund. Now let's talk about money market funds. These are the safest type of unit trust funds, investing in short-term, high-quality debt securities. The advantage here is a low risk of capital loss, making them ideal for short-term investment needs. The trade-off, of course, is lower potential returns. Finally, we have specialty funds. These funds focus on specific sectors or regions, offering potentially high returns if you pick the right one. However, they also present a high risk due to their lack of diversification. As you can see, each fund has its own unique risk and return profile. It's important to consider your investment goals, risk tolerance, and time horizon when choosing a fund. Unit trusts, like all investments, come with risks. The value of your investment can go down as well as up, and past performance is not indicative of future results. Understanding these advantages and disadvantages can help you make informed investment decisions. So weigh your options carefully, and remember, you don't have to put all your eggs in one basket. Diversification is key. Now that we have a grasp of the different unit trust funds and their pros and cons, how exactly do we go about investing in them? Diving into the world of unit trusts might seem daunting, but with a proper understanding, it can be a rewarding journey. Here's a step-by-step guide to getting started. Firstly, identify your financial goals. Are you saving for a specific event like a wedding or a down payment on a house, or are you looking to grow your wealth over a long period? Your goals will inform the type of unit trust fund you choose. Next, assess your risk tolerance. Each type of unit trust fund carries a different level of risk. Equity funds might offer higher returns but come with greater risk, while bond funds are generally safer but offer lower returns. If the thought of potential loss keeps you up at night, you might want to consider a more conservative fund. Once you've determined your goals and risk tolerance, it's time to choose a fund. Research is key here. Look into the fund's past performance, but remember, past success does not guarantee future results. Also consider the fund manager's experience and the fund's investment strategy. Now let's talk about money. Start with an amount you're comfortable with. Some unit trusts have a minimum investment requirement, so be sure to check. Remember, it's not about how much you invest, but how consistently you do it. Once you've chosen a fund and have your capital ready, you can purchase units through a financial advisor or an online platform. And just like that, you're an investor in a unit trust. Regularly review your investment. The financial market is dynamic, and your financial goals may change over time. Be prepared to adjust your investment strategy when necessary. Remember, investing in unit trusts is not a get-rich-quick scheme. It requires patience, discipline, and a clear understanding of your financial goals and risk tolerance. Investing in unit trusts can be a rewarding venture if done wisely and with careful consideration. So are you ready to start your investment journey with unit trusts? You might be wondering, how do unit trusts differ from mutual funds, and do they vary from one country to another? Well, let's delve into it. At the core, both unit trusts and mutual funds pool resources from multiple investors to invest in a diversified portfolio of assets. However, their structures and operations vary. Unit trusts are structured as trusts, managed by a trustee and a fund manager. Mutual funds, on the other hand, are structured as corporations with shareholders, managed by an investment company. Now let's talk about cross-country differences. Unit trusts are more common in countries like the UK and Singapore, while mutual funds are popular in the United States. The regulatory environment and investment culture in each country play a significant role in this preference. For example, in the UK, unit trusts are regulated by the Financial Conduct Authority, while in the US, mutual funds fall under the purview of the Securities and Exchange Commission. Moreover, the tax treatment of these funds can also differ. In some countries, unit trusts may offer tax advantages over mutual funds and vice versa. Lastly, the minimum investment amount, fees, and charges can vary significantly across countries and between unit trusts and mutual funds. Therefore, it's essential to carefully consider these factors before making an investment decision. While there are similarities, it's important to understand these differences when considering your investment options. We've covered a lot of ground today on unit trusts, from understanding what they are to how to invest in them. We've dissected the various types, dug into the pros and cons, and even explored the differences between unit trusts and mutual funds. Please subscribe to our channel, which will encourage us to make more valuable videos. And if you have any questions or need clarification, please leave a comment. Thank you for joining us on this journey to understand unit trusts. See you soon in our next video.